Have you ever looked at your rising 401k balance and felt a strange sense of panic because you can't actually use a single cent of it? You are definitely not alone. When most employees check their retirement progress for the first time, they feel a rush of pride seeing those numbers climb. Yet, they are actually staring at a digital mirage that remains out of reach for decades. Contributions, employer matches, tax-deferred growth, and vesting schedules fill the HR brochures. Yet, hidden in that paperwork is a massive restriction that turns your savings into a long-term hostage situation. Now, if you are like the typical worker, you have been conditioned to believe that maxing out your 401k is the ultimate sign of financial maturity, but you might not actually grasp how that strategy is strangling your current opportunities. Perhaps you feel frustrated when a great investment or business idea appears, but all your capital is locked behind a government-enforced wall. Maybe that one friend who just retired early makes you wonder if your safe path is actually a treadmill. Either way, you are likely questioning if this traditional advice is a golden ticket or just a clever way to keep you tied to a desk until your hair turns gray. Well, here's a reality that might shock you. The 401k is not a magical wealth generator. It is a government-regulated tax shelter that charges a massive price for its benefits. It is actually a mechanism that prioritizes your 60-year-old self over your current potential, and mastering how to balance your liquidity could represent the gap between living your dream now and waiting for a permission slip from the IRS when you are too tired to enjoy it. My name is Noah, and I spend far too much time analyzing tax codes, cash flow, and the reasons most people would rather follow a script than write their own financial future. If you want to learn how to manufacture wealth without having your money held in a cage, make sure you hit that subscribe button and like this video if it helps you clarify your financial future. Here's what most folks miss about the max out philosophy. The typical professional will blindly dump $20,000 a year into their plan, and every dollar they contribute is a dollar that loses its ability to work for them in the real world today. One account might grow steadily while another fluctuates wildly. Some plans have decent investment choices, while others have high-fee garbage. Yet, in almost every scenario, that 59.5 age requirement is waiting for you like a distant, unreachable horizon. The reason this strategy is so pushed isn't because the government wants you to be rich. It is because it keeps capital stable and predictable for the institutions that manage it. Think of it as a loan you are giving to your future self, but you aren't the one who sets the terms. Instead of freedom, it provides a promise. But before we explore why this is so limiting, let me ask you a quick question. When you think about your biggest financial goals, do they happen when you are 35 or when you are 65? You are likely thinking of travel, starting a company, or buying a home. These are the things that require liquid cash. Well, the truth is that the 401k system is designed for people who plan to stay in the race until the very end. When you over-allocate here, you are grabbing a heavy anchor and dropping it into the ocean. Now, does this sound like bad advice? Why wouldn't you want to save on taxes? These questions are vital because they explain why the liquidity crisis is the silent struggle of the modern saver. Your 401k is essentially a high-security prison for your income. Just as a gold bar in a museum doesn't help you pay your bills, $1 million in a 401k doesn't help you quit a job you hate tomorrow. This data helps you spot the difference between being net worth rich and being cash flow free. Here is the fascinating part. The obsession with maxing out is fueled by a narrative that tax savings are the only thing that matters, but they never talk about the cost of being stuck. There is a specific committee of regulators who decide exactly when and how you can access your own labor. Think of it like a parent who holds your allowance until you graduate, but instead of school, you are waiting for old age. To navigate this system, you must satisfy strict rules of your own. You have to be honest about your immediate needs, possess a clear view of your entrepreneurial goals, and show actual liquid strength in your portfolio. You also must resist the pressure to follow the herd to ensure you aren't just a temporary trend. This rigorous balance is exactly why flexible investors have historically dominated. You aren't just waiting for a date on a calendar. You are keeping your options open for whatever the world throws at you. It is like having a fast boat ready to sail, but instead of a destination, the prize is your autonomy. But there is a detail about tax deferral that might catch you off guard. Even though you save on taxes today, you have no idea what the tax rate will be in 40 years. The more you put into these accounts, the more power you give the future government over your lifestyle. So when tax laws change, it carries your risk much higher than if you had paid the tax today. This means the structure of your 401k actually drives a huge portion of your future uncertainty. We are talking about the loss of control. When you can't touch your money, you can't pivot. Now, having your money concentrated in a locked vault isn't a safety net. These are accounts that require you to play by someone else's rules for decades. They have survived market cycles, but they don't offer you a way out. Investing solely in a 401k is essentially betting that your life won't change and you won't need that capital for anything else. But here's the part that many financial planners won't tell you because they get paid to keep your assets under their management. A standard brokerage account offers a level of power that a 401k can't touch. For years, the industry has ignored the value of being able to sell an asset and use the cash tomorrow without a 10% penalty. Think about that reality. You have people with six-figure retirement accounts who are stressed about a $3,000 car repair. They get nervous about their job security while they have enough money to live for years sitting just out of reach. And yet, the majority of them continue to max their contributions year after year. It is like a thirsty man standing next to a locked water tank while holding the key to a future that hasn't arrived. The data is quite embarrassing for the max-out advocates. Research shows that having liquid capital allows people to take risks that lead to much higher wealth than a 401k match ever could. That means if you kept your money accessible, you would have given yourself a better chance at exponential growth than if you had just followed the standard HR manual. How is that possible? How can paying taxes be better than a tax break? The answer is found in the velocity of money. While that sounds like a dry textbook term, the idea is simple. Money that is moving and accessible has more value than money that is static and locked. When you have liquidity, you can buy a distressed property, fund a side hustle, or bridge a gap during a recession. When you commit every extra cent to your 401k, you lose the ability to act when the world goes on sale because your hands are tied. It is like trying to win a game of poker while your chips are glued to the table. Someone is going to take the pot while you are still trying to peel your bet off the felt. This leads us to a core truth of building wealth. It isn't just about how much you have, it is about how much you can use. One of the biggest wealth killers is being forced to take a high-interest loan because your wealth is stuck in a retirement fund. When you are in a liquidity crisis, you might have a high net worth, but you are functionally broke. That math is terrifying. If you have all your money in a 401k, you pay penalties to use it. But when you need cash, you are paying for the privilege of accessing your own work. You are basically a guest in your own financial life while the government charges you for the visit. These costs also compound. That 10% penalty isn't just a fee, it is the loss of all the future momentum that capital would have built. Over 30 years, a lack of liquidity can literally cost you the ability to retire early. This is why many savvy investors are shifting their focus to brokerage accounts and liquid assets. They even show examples of people who paid the tax now and ended up with a life of total flexibility at 40. Even without the free money match, the liquid investor often wins because they can seize opportunities the 401k saver never sees. The beauty of a liquid approach is that it removes the age-based deadline from the equation. You don't have to worry about the government changing the withdrawal age to 67 or 70. You get a sovereign system. When you decide to retire, your wealth is ready. Over the long haul, liquid portfolios have shown an incredible ability to provide freedom, which leads to consistent peace of mind for you. Let's look at the actual numbers, because this is where the theory becomes a reality. A 10% penalty on a $50,000 withdrawal is $5,000. Plus, you pay the income tax. If you had invested that in a taxable account, you would have paid capital gains, which are often lower than income tax. If you invested $10,000 a year in a brokerage instead of maxing the 401k, by the time you were 45, you would have put in less than $200,000, but your balance could be enough to fund a career change. That extra freedom didn't come from a tax break, it came from the power of accessibility. This mathematical freedom is the most powerful force in finance. If you start now and just contribute up to the match, you could easily end up with a diversified empire while your colleagues are still waiting for their 60th birthday. That is the reward for having the wisdom to stay liquid while you build your future. Now, I know the employer match is hard to walk away from, and you are right to take the free money that is offered. But here is the secret. Maxing out beyond the match is a trap for the average person. Think of your brokerage account as your freedom fund. When your liquidity is high, your stress is low. When the next market crash happens, and it always has, the person with the cash in a brokerage account is the one who gets rich, while the 401k saver just watches their screen. Successful investors don't want a someday life, they want a today life. It is like choosing to own the car instead of leasing a dream you can't drive. But you will still hear critics. Financial gurus will claim you are missing out on compounded tax savings. They will show you complex charts that seem to prove the 401k always wins. What they won't show you is the value of a business you didn't start or a house you didn't buy because your money was stuck. Complexity sells because it makes the retirement industry look essential. But in the world of money, the simplest path to freedom is the one where you hold the keys. You have to decide if you want to be a millionaire on paper or a millionaire in practice. Sometimes, being wealthy means choosing the taxable, flexible path. A 401k isn't your only option. It is just the one your boss wants you to use. Whether you decide to stop at the match or pivot to a brokerage, the key is keeping your power. The best strategy is the one that lets you live at 40, not the one that only works when you are too old to care. If this helped you rethink your 401k, please give this a like for Prime Noah Invests and let me know in the comments if you are maxing out or keeping it liquid. See you in the next one.